Welcome to the first learning outcome, where we build the vocabulary of business strategy. Before we get into the clever models, we need to be clear on what strategy actually is and the concepts that shape it, from mission and culture to stakeholders and competition. So let's start with the big question. What do we actually mean by strategy? At its heart, a strategy is a business's long-term plan for getting where it wants to go, and it answers three simple questions. Where are we now? Where do we want to be? And how will we get there? Think of how Netflix shifted from posting DVDs to becoming a streaming giant. That whole direction, planned over years, is strategy in action. Everything else in this unit builds on these core ideas, so it's worth getting them straight now. It helps to separate a few terms that often get muddled. The mission, or aim, is the overall purpose, something like being the UK's leading value grocer. The strategy is the route you take to get there. An objective is a specific, measurable target along the way, and a tactic is a short-term action, like a seasonal price promotion. If we take Aldi, the aim might be unbeatable value. The strategy is a lean, low-cost model, and a tactic could be its weekly special buys. Notice how these levels connect into a chain. Aims come first, the broad, long-term goals like growth or survival. Then strategy is the chosen route, and objectives break that route into measurable targets for teams. Say a company's aim is growth. That might lead to a strategy of expanding online, with an objective of 20% of sales coming from the web within 2 years. Strategy is really the bridge between the big picture ambition and the day-to-day work staff are actually measured on. Let's look more closely at how a business puts its purpose into words. A mission statement says what the business does now and who it serves. A vision statement describes what it wants to become, and its values are the principles guiding how it behaves. Take Google, whose long-standing mission has been to organize the world's information and make it universally accessible. That single sentence has shaped decades of decisions. You might wonder whether these statements are just words on a wall, but a good mission genuinely earns its keep. It gives everyone a shared sense of purpose. It guides tough decisions by asking, does this fit what we're about? And it signals to customers and investors what the business stands for. Tesco's long-running idea of serving shoppers a little better every day is a neat example. It quietly keeps the focus on value and service. Let's make that concrete with a grocer. Imagine a national supermarket whose mission is offering great value and quality to everyday shoppers. That purpose drives a strategy of low prices, strong own-label ranges, and stores close to where people live. From there, the objectives follow: open more convenience stores, grow the value range, stay cheaper than rivals. When the mission and the daily decisions about stock and layout line up, customers get that consistent, recognizable brand experience. Now to something less visible but hugely powerful: corporate culture. Culture is the shared values, beliefs, and ways of working that shape how people actually behave day to day. Where it's strong, those values are widely shared and give a business a clear identity. Think of the customer-first feel at John Lewis. Where it's weak, values are vague or ignored, and behavior becomes inconsistent and hard to manage. Here's why culture matters so much for strategy. It decides how quickly a business can adapt, innovate, and take risks. An open, experimental culture supports bold new product strategies, while a cautious, hierarchical one tends to favor stability and cost control. Compare a firm like Amazon, famous for constant experimentation, with a traditional high street bank that moves far more slowly. Culture can be a real strength or a genuine barrier when a business tries to change course. No business operates in a vacuum, and competitive pressures are the forces from rivals and the market that push it to perform. These include price competition, new firms entering, substitute products, and increasingly demanding customers. When Aldi and Lidl arrived in force, they piled intense price pressure onto the established supermarkets. And strong competition like that forces firms to cut costs, raise quality, or find a way to stand out. It's worth seeing competition from two angles. As a threat, it squeezes profit margins, lets new entrants grab market share, and makes it easy for customers to switch to substitutes. But it's also a driver of improvement. It pushes firms to become more efficient, it encourages innovation, and it rewards those who differentiate well, the way Ocado turned online grocery delivery into a genuine technological edge, rather than just a threat to react to. Let's turn to the people and groups who have a stake in what a business does. A stakeholder is anyone with an interest in or affected by the activities of a firm. Internal stakeholders sit inside the business, the owners or shareholders, managers and employees, while external ones sit outside it, customers, suppliers, government, lenders and the local community. For a company like Greggs, that web stretches from its bakery staff right out to the high streets its shops sit on. Each of these groups wants something slightly different. Inside the business, shareholders want profit and a return on their investment, managers want growth and reward, and employees want fair pay, decent conditions, and job security. Outside it, customers want quality at a fair price, suppliers want reliable orders and prompt payment, government wants tax and jobs, and the local community wants employment without too much disruption. If we lay those aims side by side, the pattern becomes clear. Shareholders are chasing higher profits and dividends, employees are focused on security and fair pay, and managers on growth and status. Meanwhile, customers want good value, suppliers want to be paid well and on time, and government wants compliance with the law. When Nissan makes a decision at its Sunderland plant, you can see all of those interests pulling in slightly different directions at once. Because these groups want different things, their aims can clash. Shareholders might push for higher profits, which could mean holding down the very wages employees are fighting to raise. Customers want lower prices, while suppliers want higher payments. This kind of conflict can slow decisions right down and make it harder for a business to hit its objectives, so it's not something managers can simply ignore. Let's see that tension play out. Picture a supermarket that plans to automate its checkouts and open a large out-of-town depot to cut costs. Shareholders and managers are all for it, lower costs, higher profit, but employees fear for their jobs and resist, while local residents object to the extra traffic and noise. Managers are left balancing those competing demands, and that conflict can easily delay or reshape the whole plan. So how do managers handle all this? They weigh up each group by its power and its level of interest, and give the closest attention to those who have plenty of both, major shareholders, for instance. Good communication and a willingness to compromise go a long way to reducing conflict and building trust. Handle it well, and balancing stakeholders can actually become a genuine source of competitive advantage rather than just a headache. Let's draw the threads together. Strategy sets the direction, mission and values give it purpose, and culture shapes how it's actually delivered on the ground. Competitive pressures keep pushing the business to sharpen its strategy, while stakeholders influence it and bring conflicting aims that have to be balanced. Hold on to these concepts because they're the foundation for the models and tools we'll explore in Learning Outcome 2. Let's recap what we've covered. Strategy is the long-term plan for achieving a business's aims, with aims, strategy and objectives linked in a chain, and a mission statement sets the purpose and steers decisions. We saw how corporate culture can either support or block a change in direction, how competitive pressures force firms to cut costs, innovate or differentiate, and how stakeholders, both internal and external, hold aims that differ and often conflict. Keep those ideas close, they underpin everything that follows. That brings us to the end of the first outcome, where we've built the core vocabulary of strategy, from mission and culture through to stakeholders and competition. If you'd like to go further, the further reading pulls together some excellent starting points, including Johnson and colleagues' Exploring Strategy and Michael Porter's classic Harvard Business Review essay on what strategy really is. The websites listed, like Tutor2 and Mind Tools, are great for quick, clear refreshers, and the Tesco and Greggs case studies show these ideas at work in real firms. Do take a look on the Moodle and give yourself time to let the concept settle before you tackle the assignment.